Welcome to the Are You Ready podcast series. I'm Neil Cockburn, your host. Today's guest is John Stevens. John is with Camilla Advisory Group. He's president and founder, and that group works with employee ownership plans and devising, engineering, advising on putting plans together for companies. He's been involved with that for many, many years, and he's got a lot to say on that topic. We look forward to jumping right into it. Welcome, John, to today's episode. We've got a bit of a history going back a few decades.
We do.
We met at working at Deloitte's some time ago. Won't say how long, but a few decades ago. And since then, we've kept in touch through your journey through different companies, and more lately your work with employee succession, chatting about some specific clients. So, tell us a bit about your history. How did you get to this employee ownership?
For sure.
Focus.
Yeah, great question, Neil. So it actually goes back to the days at Deloitte's. I don't know if you remember, but we worked with Julie Gaudry. And Julie was the wife of Gary Gaudry, who was the CFO of Marlin Travel.
Right.
And so back then, Marlin Travel was an employee-owned company. It was started by Rodman Marlin in Edmonton here, and then had employee ownership. And Julie and Gary had such great things to say about the employee ownership culture. And so I always had in the back of my mind that conversation about employee ownership. And then as I went on throughout my career, I put in place employee ownership at companies over time. And then 6 years ago, we started a firm to help other companies because I really thought it was a need in the marketplace. There's obviously a lot of, you can go to accounting firms and get your tax advice, and you can go to lawyers and get your legal advice, but we're really good at designing and helping with that, but we really help implement it and communicate it to the employees. So it's been a neat journey.
Okay. So yeah, I think that's a good point. There's lots to it in terms of just the understanding how it works.
For sure.
Logistics, financing.
Yep.
Lots of different elements. So the plan itself, in terms of just the shares, the lawyers and accountants can do that.
Yeah, for sure.
But the rest of it is quite important, and understanding and getting this to a successful plan, I guess, is important. The series is all about are you ready? And for many business owners, they look at different things when they want to exit the business. Many start with a sale, but employee ownership, I think, is an important component. Could be in a sale, could be the exit strategy on its own, or could be some kind of we talked a bit about some hybrid models that we're starting to see.
Yeah, for sure. So clients come to us for two reasons. One is succession, as you talk about with the series that you're doing, where it is a great strategy to exit the business, is to sell their business to their employees. And there's different ways that you can do that, and we'll talk about that. But the other reason we get a lot of clients come to us as an initial step is the engagement of the employees. And so just getting those employees engaged. Employee ownership can be a journey because it's an education piece with the financial literacy. So we'll see clients that maybe start out in the engagement, then do think of it as a succession piece down the road where they can sell the business to their employees.
Okay. So the employee ownership can enhance the value of the business. I think we talked about that in one of our other episodes about, creating value in the business.
Absolutely. There's not as many studies done in Canada because employee ownership is relatively new. There's been all kinds of different versions of it. Obviously, there's employee ownership trusts, which the government introduced a couple of years ago. But if you go to the other G7 countries, we were the last country to actually implement any type of tax incentive for employee ownership. And so it is interesting how the tax incentive has renewed the interest. Employee ownership trust, we can talk about that later, whether that's the right structure, but it's really renewed the interest in Canada with people talking about employee ownership as a succession planning, maybe some of the other structures that are out there.
Yeah, no, I've seen that. A lot of clients asking questions, and we'll talk a bit more. I mean, the current legislation's got a few quirks to it, but it is a trend, like you say, in other countries. That's a good segue into different types of employee ownership. There's different strategies, different plans, different structures. Maybe talk a bit about some of the options.
Yeah, for sure. So there's ones that we like as a company. Obviously, we were talking about it earlier just before the podcast. You can do a standard freeze and transfer some of that common ownership or common shares to employees. Where we see that, we think that that's not the best strategy. Our two favorite, and maybe the first one we'll talk about, is the share purchase plan, where the employees are actually purchasing shares from the owners of the business. A lot of time that's done with a loan. It can be done where they dig into their own pockets. That loan can come from the bank to the company and then to the employees. That loan can come from the company. It can come from the owners. There's different ways to structure it. But we do see a fair bit of financing. You need to be a fairly large company for the banks to lend directly to the employees with a large number of employees. But we work with a lot of the banks to put in place loans to the companies. BMO, Bank of Montreal is an example where they have one individual across Canada dedicated to employee ownership and loans for employees. And so they've taken a big interest in another one local here that I met with recently that has a big interest. One of their senior folks is Service Credit Union. Oh, okay. And how they came about it was interesting is the gal's husband worked for PCL. And we can talk about the PCL story because I can tell you a little bit about that as well. But she just felt she saw other banks doing it as well and wanted to get involved and saw succession planning as a real need of some of their clients. And so they're doing loans now for employee ownership to companies that are lending to employees. So the banks are definitely getting involved. We work with a lot of them and see that there is a strong interest. And again, the employee ownership trusts, I think, kind of push that interest forward a bit.
Yeah, okay. Yeah, I was reading an article on stats, and it's about a year old. It was talking about what companies would look at for strategy and employee ownership. I think they quoted 24% of owners if you're looking at employee ownership. Yeah. I'm thinking that number is probably gone up with some of the.
Yeah, I probably would agree with that. We get a lot of inquiries. It's interesting. We get a lot of people talking about it. It's a bit of a long sales cycle because it's a hard thing when you have control of the company to hand some of the keys over to your employees, obviously through governance and non-voting shares, and that's where we can help. There's a lot of things you can do to offset that control piece that you're handing over. So it's a long sales cycle. It takes a while to get used to it. I think the more individuals can talk to other companies where it's a success. And you asked the question earlier, some of those studies in the US, the businesses that have employee ownership, they consistently have higher revenue, higher costs. And it comes almost naturally because employees before are thinking about Friday, their paycheck. And as soon as you give them a part of the business, their mindset changes and they start thinking about where can that additional revenue come from? How can we control some costs? Or they treat that piece of equipment, maybe they're operating a little bit better because they own a piece of it. And we see that time and time again. I've sat on the Employee Ownership Canada board for a long time. And so I've gone to conferences across Canada, went to conferences in the US. And my favorite piece about going to those conferences is talking to the owners that have put employee ownership in place and the differences that it's made to the businesses in terms of additional revenue, more engagement, control, and obviously that's going to drive growth to the business and ultimately drive value to the business, right?
Yeah. Okay, awesome. So options, we're talking about the standard freeze.
Yeah.
You bring employees in, which we've been involved with, the employee share plan, so they're purchasing shares for a period of time. Perhaps options are included in that. So.
Correct. So there's probably 5 main options that I look about. So let's call it the freeze, the share purchase that we talked about, and there's different ways that you can do the share purchase. It can be direct financing, employees dig into their jeans. We even do payroll deductions, those type of things. The options. So options are considered a standard employee ownership. We find that those only work best in high growth companies. So they're used in startups and tech companies is where we think those work the best. The phantom share plan, you'll see that from time to time. I'm not a big fan of that. I don't even like the name of it. It's hard to get employees engaged when you're giving them a phantom share just because of the name. Mm-hmm. But we do something called a restricted share plan. So similar to what public companies do. And the reason we do that is because it levels the playing field for the employees. And that's one of the things that's really important for us when we design and implement an employee share plan is we want to make the plan as equitable as possible to all employees. And we don't want to distinguish between somebody that may have a lot of money and somebody that may not have them. One employee maybe a manager and the other guy's the exact same manager. One might have 5 kids at home and maybe an ex-wife and the other one's Signal. And so he's got a lot of money and can buy more shares. And so you really need to, because you can create silos within an organization. So with the restricted share plan, essentially on a tax efficient way, you're giving the shares to the employee. It's not a huge dilution. As we talked earlier, it can really drive the value of the business, but it can create this level playing field with employees where everyone sort of has an equal amount, and it works quite well. We've done that a lot. We do that in conjunction with a share purchase plan, just to get the engagement and to change that culture a little bit. So it's an important part of the communication piece. And so we like, those are our two favorites, are the share purchase and the restricted share plan.
Okay. The acronym, accountants are good at acronyms.
Yeah.
The acronym is the ESOP, which
Yep.
in the United States, they have the employee stock ownership plan, which are basically like an employee trust, similar to what's done in Canada.
Yeah.
Familiar with that? We got a inbound client that has operations here in Alberta, and they're owned in the U.S. through an ESOP. So familiar with that plan. So we'll use that term ESOP because I think that's kind of generic, covering all of these different plans. What would the attributes of a company? What would be a good candidate for an ESOP?
Obviously, one that has good cash flow and has good growth potentials, because a lot of the ownership, as the employees buy the business from the owner, comes from future cash flow. And so if you have a business that doesn't have stable cash flow and good growth opportunities, a lot of times it can be difficult to put an employee share plan in place. The other thing you want to have is you want to have good management. And so it's important that, especially if it's a succession planning where you're going to exit the business over time, you're going to have good management. Open book business is important. So just sharing those numbers with your employees, you don't have to share all the detail, and there's certain ways that you can share it so you're not putting all the cards on the table. So we think open book management is really important, and financial literacy. Obviously, you want your employees to understand what this is all about, and you can build that over time. And so the capital needs of the company, probably minimal going forward. So you want something that can support that growth, because again, you're going to need that cash initially, especially if they're going to buy it fairly quickly through a share purchase plan. So the designs can be different depending on what you want to accomplish. But those are some of the keys: strong business, strong balance sheet, little debt, growth, good management.
Well, and to make it really work, financing. I mean,
for sure.
Unless you got a bunch of employees with a lot of cash, which
Correct.
is not common.
Correct.
Then financing is needed, which requires cash flow to fund it.
Yep.
So you're paying out of future operations. So interesting on the financing, the options opening, because I'd say 5 years ago that was not the case. You didn't see as many options. Yeah,
PCL obviously here in Edmonton is the classic employee ownership, and most of the banks were involved with financing. So, with PCL, I think it opened up some of the doors. Construction is where a lot of employee ownership in Edmonton, even across Canada now, if you go to the construction companies, most of them have some form of employee ownership, and they needed to do that in order to compete with PCL. And PCL is such a great Edmonton story when they started in 1977 when Bob Stollery, everybody knows, if you're local here, the Stollery Hospital, where 25 managers and Bob Stollery bought the business, but they did it through debt with a lot of the banks. And so that was kind of, I think, where a lot of the financing kind of started, where everybody wanted to be involved, and it's expanding obviously with the employee ownership trust legislation that was introduced.
Okay. We talked a bit about different types of ESOPs. I think you got into it. Maybe just clarify again, advantages, disadvantages, one versus the other. Again, the restricted plan you talk about. What's any disadvantage to that?
Dilution is the biggest disadvantage, where you're giving away part of your company essentially for free. But what you get is engagement and more growth. Within the studies that we've seen, in terms of our clients, the growth is far outweighed, in their opinion, the dilution that what we've seen over the last 5 years. So that's a big disadvantage to that one. I think financial literacy is something that's so important, and it comes down to that communication piece, and that can cause issues. We talked about the share purchase, especially if you open it up to employees. So there's some obviously eligibility criteria as to which employee can purchase how much is an important part of the design phase, where you figure out that piece, and just ensuring that one particular manager doesn't end up with a bigger percentage with someone else is an important piece of making sure that you structure it correctly. But both of them, we think, work very, very well. One better for succession, obviously, and one better for engagement.
So on the dilution, I guess the there's a disadvantage to it, but if you got a smaller piece of a bigger pie, then
Correct. We always say that.
the net's better.
Yeah.
So that's the,
Yeah. What would you
if it works
rather?
well, that's what you end up with.
No, for sure. What would you rather own? 100% of a small little hardware store in some town, or a small percentage of a big chain of hardware stores?
Okay. Financial literacy, and again, talking about the kind of things that you do. I mean, there's the plan.
Yeah.
A lot of what you do, I understand, would be coaching and getting that financial literacy and helping them to understand the communication.
Communication is a big piece. We'd actually like to do more financial literacy. I think it's a piece missing just with employees in general in companies, just so that they understand simple concepts like return on equity, difference between markup and gross margins. Amazing how many employees don't understand simple little things like that. But what we do a lot is just have the employee really understand what this employee share plan is all about. And so one document that we do with all our clients that I love, and my goal with that document is it's a frequently asked question document, and depending on the plan, it can be anywhere from 30 to 45 questions long. And my goal always is that for that employee, after we've done a presentation to the employees, to take that document home, put it on their kitchen table, be able to read that document and have a pretty basic understanding of what this employee ownership thing is all about. And so we work hard at that. Obviously, every plan's a little bit different. Every company's a little bit different what they want to accomplish, but that's a document that's served us well, and we really work on that with the employees. But it's something that the company has to do, is continue to build on that financial literacy piece and get their employees to understand and annual communications and such. One of the things that we do with all of our employee share plans, so restricted share plans, share purchase plans, is we'll work into the shareholder agreement something called a mini market. And we find that annual valuation of the company where you reveal what that share price is. And the mini market, and we usually don't do it in year one, but it's in year 2 or year 3, it gives the opportunity for the employees to exchange shares. And so it's the company sets the value once a year based on the financial statements. But that can create a lot of financial literacy with the employees, because employees get excited. Okay, when we launched this last year, the shares were worth $10. Now they're worth $12.50. We went up 25%. Yeah. So what does that mean? Can I buy more? And so they really want to understand, is our revenue increasing? What is our return on capital? And so it becomes a nice education piece, and companies can work that around that annual evaluation and that piece that, here our revenue grew by this much. This is what our earnings per share, it's usually a public term, but we like that earnings per share concept with private companies because employees can relate to that. I paid $10 for these shares. This is what the earnings per share. So that annual mini market, which does create some liquidity, because that can be one of the disadvantages with employee share plans is you just don't have liquid shares, but it can create a small amount of liquidity and that creates engagement and culture where you're 3 years into an employee share plan, an employee sees, oh, this guy took $20,000 off the table and went and bought a boat with his employee share plan. This thing's a pretty good deal, but it does help with the literacy and the culture. And so that annual valuation reveal and mini market concept is really important to financial literacy.
Well, I think my experience, the mindset. Yeah. So going from an employee to being an owner.
Correct.
It's a different mindset.
It is.
You're still getting paid. You're still an employee, but now you have a piece of the pie. So you're wearing two hats.
But it also is an education piece, the two hats concept, and we say that a lot, is because what happens sometimes is that all of a sudden you implement this employee ownership, and the employee thinks he's the owner now. He thinks he can make every decision in the organization. So you got to remind him it is two hats. You got to put whatever your role within the organization hat back on, and then you put your ownership hat back on.
Well, and I think you touched on governance. So that's the governance and
correct.
Setting the proper roles and setting those expectations around that is important. Without that, then
for sure
you've seen that before.
Yeah, absolutely.
Okay, we've mentioned a few times employee ownership trusts.
Yes.
EOTs is the acronym for it.
Correct.
So that's new legislation came into Canada. Again, we're one of the last countries. I think I heard the legislation was basically from the UK, is kind of what they used as a template. Maybe talk a bit about that.
Sure. It's actually a hybrid between the UK and the US. So there's components of the UK and then there's components of the US as well. So legislation wasn't passed till June of 2020. 2024, but it was retroactive to, no, actually June 2020, get my years right? June 2025, last year. It was retroactive to June 1st, 2024, and they put it in place for a 3-year period. So it's going to expire December 31st this year. And so the big carrot with employee ownership trust was a $10 million capital gains exemption. And so if you sell your business to your employees, you get a $10 million capital gains exemption. You have to sell 51%. So that was one of the negatives, because as we talked about earlier, you don't get a bucket of cash. The employees don't have a bucket of cash right away. You're going to get paid for that over time. And there are financial institutions that are very excited about financing that as well. We've talked about it actually before the podcast here. There are quite a few family offices and different private equity firms that we've talked to that are possibly interested. We haven't done any yet. There's only been a few done in Canada, partnering with owners to sell 51% where they would come in and own 49%. That's one of the things. So the $10 million capital gains exemption, one of the big issues that they had with the legislation is holding companies weren't eligible.
Right. Yeah.
And so they cleaned that up in August of last year, changed that legislation. And so now you can do it with holding companies. We really were hoping that the legislation would be extended because it's a long, as we just talked about, this is a long cycle in order to structure things and get things ready. We do think that we will see an extension. There hasn't been too many companies do it so far. We had 3 as of last September. There have been a couple more actually convert to employee ownership
That's
trust.
across Canada.
That's across Canada that we're aware of. There might be a few more, but we had a conference in September last fall, and the 3 companies that had done it were all there, and they were speaking as to what it. I think part of that, we had a huge interest 2 years ago when it sort of first came out, but everyone that was interested, every client that we talked to, it was a holding company issue, and they just couldn't do it, couldn't get that $10 million advantage. Right. We think for the right business, and we talked about some of the attributes are similar. I think you need to be the right size of business as well. It's not going to work for smaller. You probably need at least 25 employees before an employee ownership trust would work. But we think it's a good thing because there's lots of, for the right businesses, smaller towns where a strategic conglomerate might come in and buy that business and shut that facility down, where the facility owned by the employees over time could make some good dollars. So we think it's good for Canada. We think the structure maybe needs to change a little bit. There are some governance things you can do in order to deal with that fact you're selling 51%, but essentially you're not, because they still owe you the money over a period of time. If you go to our website at camillagroup.com, under employee ownership trust, we actually have a PowerPoint in there with a case study that we show a bit of an example of some of the things you can do from a governance perspective with the board of the trust, as well as the board of the company until that loan is paid off over time. So there's a lot of different ways to structure it. Like I said, we haven't done one yet, but we've had a lot of inquiry. I spoke a lot about it last year. I probably presented to half a dozen to 10 different groups. So there was a lot of interest. The interest, in my opinion, has kind of died off a little bit because everybody knows until it's extended is coming. But it's an interesting option for the right business.
Well, and like you say, the supposed to expire at the end of the year, but hopefully the government can see that this is a trend that they really need to be supporting.
Yeah, for sure.
I had a stat in one of the other sessions talked about it was 76% of small businesses plan to exit in the next 10 years.
Yeah.
So if you figure that out, who's coming in to buy those? Who are the buyers?
No, for sure.
Well, there's a ready market in terms of the employees that are there. So if you get the right structures in place.
We think it's a good solution. So one of the companies that converted or sold to the trust was a company called Taproot, and so the finance minister last fall actually attended their launch. So if the finance minister is attending the launch, you'd think that they're probably hopefully going to extend this thing for a while. So no, it would be great to see. And there's lots of people working really hard to with the government.
I think you mentioned you're part of the
I was on the board for a long time. Actually, my term came to an end in December of last year. So I'm no longer longer on the Employee Ownership Canada board, but I was very involved up till that point in time, and obviously still know a lot of those folks. And I think they're doing a real good job lobbying the government. And like I said, hopefully we'll see an extension of that 10 million, because it's a great solution for the right business to sell
Again,
over
you look
time.
at the trends and you look at where things are headed. I think it's almost necessary.
Absolutely.
In many sense. Okay. I think we've touched on a lot of stuff. Any other pitfalls of ESOPs that you see, things to watch out for, and maybe there's some solutions to that? Again, the governance, I think, is one that you've touched on here.
For sure. In financial literacy communication, we touched on that. ESOP doesn't solve everything. There's been some examples of good companies that ESOPs haven't worked out so well. Everyone's familiar with PB Mart. They had a bunch of locations around there. They had a very good ESOP program, broad, where employees can get involved. And you walked into one of their stores, I can tell the difference when it's employee ownership. It kind of goes back to that WestJet model where WestJet first started 30 years ago, employee ownership. You went on a WestJet plane back then, you could tell the difference. And I've used to fly in Southwest back. There's still employee ownership, but you could tell the difference on a Southwest airplane. You could tell the difference in when you walked into a PB Mart store as well. Fortunately, just recently, unfortunately, they went through a process. So strategy needs to align with ESOP. And they did a big, I don't know all the reasons why what happened to them, but they did a big acquisition. But so you have to have a good strategic business. ESOP isn't going to solve it all. And so you need a business that's robust and a business that's growing. And so that can be a real negative to employees, especially if loans are involved and such. And all of a sudden the value of the business has gone down. So we see that from time to time, but definitely the case is opposite, where that engagement of the employees, we can see you still need good management driving strategy. So,
well, and I'm hearing behind that, it's not for every employee, perhaps.
That's a good question, and it's a really good question, Neil, because we talk about that a lot with our potential clients, because that's kind of the difference between a restricted share plan and a share purchase plan. And with a restricted share plan, we've never seen a case where an employee doesn't participate, because you're given the shares and they vest you over a period of time, and it's designed to be an annual plan. But with a share purchase plan, with the loan, even though if it's a loan from a company, I've seen on more than one occasion employees that did not participate. And I know two examples where, and I'm not going to pick on engineers, but we're both accountants, so I can pick on engineers a little bit, that two engineers that didn't participate in the loan program gave up checks for over $1 million worth of employee ownership 8 and 10 years later, when the business ultimately was sold to someone else. And it just was because they didn't understand it, and they were conservative. So you're right. There is a lot of people that don't participate, but it's one of the things where you need to try and even that out from an eligibility perspective, because you don't want to create silos within, because that can be a negative with ESOPs when you create silos where, as I talked about earlier, when one of the owners ends up with a lot more shares, and an employee can be jealous of a different employee even though they're in the same role because he bought the shares and the other one didn't buy the shares. So it's a really important piece to manage. So it's a great question.
Communication, literacy, and
I
was just thinking, there would be some that would make that choice not to for many reasons, and probably just understanding risk averse. Engineers are risk averse. Okay, I know a few of those. Okay, maybe just kind of capsulize or summarize. What does your firm do? Like, what's the value add you have when looking at these plans?
For sure. So we touched on it earlier, but our engagements are essentially design. And lawyers and accountants can do that, but we've seen a lot what works in what situation and what doesn't work in certain situations. So we can complement that design phase with the tax and accountant. And we'll do a lot of work up front before we actually even bring the tax folks or the legal folks in. And a lot of times it's just a rubber stamp that this makes sense, because we really try to dig in and understand what the company or the owners are trying to accomplish with their interest in employee ownership. So that's the first phase, is the design. And A design and implementation could take anywhere from 6 months up to a year. And then once the design is done, we'll move to implementation. And so that's the implementation, communication piece where we really work on, okay, how are we going to communicate this to employees? We're not valuators, but we do work with the different firms that will come in and do valuations, and we're part of communicating the valuation to the employees. And so design and implementation are the big piece of what we do. And I think we're pretty flexible, and we really try to meet the needs of what our clients do and build on our experience. My partner, Jason Vandenberg, we worked together for 20 years. So prior to starting the firm 6 years ago, we've implemented several different employee share plans for companies we were involved with, both private equity, public companies, family-owned businesses. So we have a lot of experience, and that experience that we've gained also from talking to so many companies over the years, what's worked, what hasn't worked, that's where I think the valuable lessons we can take as a firm and help companies.
I guess one of my final questions, and I think you've touched on it, is the time frame involved in this. You say like about a year for looking at design the plan, and then once that's in place, then probably implementation would be over a period of time as well.
Yeah, typically I would say 6 months to a year. If it's a simple company, not a lot of shareholders, not a lot of structure issues that need to be dealt with up front, we can move relatively quickly. Usually it's the clients that dictates how quickly that we can move. When part of our design and implementation, typically we'll set up biweekly meetings. We'll do that over a period of 6 months, and we'll start with design and communication. And owners are involved with that. HR is involved a lot. Finance is involved. The ESOPs tend to land with the HR and finance departments, but some companies it's just the owner that we're meeting with. So the more people involved, seems the longer it takes to get it implemented. So it depends on the size of the company, but we usually have it done with a year, and then it becomes an annual thing that we talked about before. And so we usually get involved for a few hours on an annual basis, maybe a day or two, just to help with maybe updating the communication piece, looking at the valuation, eligibility for employees, those type of things. So we do that quite often, where our clients will come back and engage us on an annual basis to help out with them, or the mini market concept that I talked about earlier. And but it is a long sales cycle, as we talked about, because people start thinking about this, and you quoted some stats. They'll start talking to us, and I think we engaged a client here recently that we started talking to 3 years ago.
Okay.
Yeah.
Okay. Well, the theme of the series is "Are you ready?" So, if you're not ready, then start getting ready and having conversations. Perhaps chatting with you about, or looking at the options for stock ownership. That's maybe a piece, and it can be a piece of third-party sale. It could be a piece of some sort of a hybrid structure, or it could be the ultimate succession for the business. So definitely a good option, and appreciate that you've got that experience and bring that to your clients. And so I want to thank you for the discussion today. And if you have questions, contact information will be available for John. So if you have something that tweaks in terms of you want more information, or the website you said is
CamillaGroup.com.
is a really good resource just to see a live example of how this all works for you.
Yeah, absolutely. So no, thank you very much, Neil, for having me here today. It was great, and like you said, there's lots of options out there for people that want to explore this. So it was great to be here. I love talking about employee share plans.
Okay,
so thanks for having me.
Your passion shows. Thanks again.
Excellent.
To learn more about Neil Cockburn and KRP's Family Enterprise Advisory Services, visit krpgroup.com.
This series is proudly produced by the team at Road 55. Road 55 creates content that connects. For more information, visit our website at road55.ca.